There's another income method that's really fun to use, that I use sometimes, but I really like to use around earnings, and that's income method number 6. Income method number 6 is essentially a bear call spread. So let's just go back to that PAS example real quick, and then we'll take Edward's example. So we saw there that selling the call below the put strike price was a bad idea because we increased the risk to the upside. And why would I have opened this infinite potential upside position with a put that's 231 days out? And it's because I probably have the expectation that this stock could grow 3 to 6% in the next 20 to 40 days, and probably another 4 to 8% in the following 60 to 90 days after that. I'm looking for a growth stock. It is a bullish strategy. We have income methods that help you in these adverse situations that Edward's talking about. We're going to get to those in a moment. Now, even if I took, quote unquote, let's go out 14 days, let's go out to 21 days to June 21st. Correctly, if I sold the June 24 call, again, it's only going to give me 30 cents. I understand that it's half of what we could get by selling that 22 strike right now for only 7 days out. But here, not even, but here we have a little more favorable break even upper and lower. We sold the call at the put strike price. We have a max profit of 6.6% in 21 days. If the stock's trading right at 24, hey, that's pretty good. But what if I expected that this stock was coming up to earnings with the potential that, hey, it might fall and I want a little hedge against that position. It might shoot up in price and I don't want to cap my upside as I would with a covered call or limited gain with a cash secured naked put or a vertical spread. I got into this position because I expected that growth. I'm going to leave the upside open. So why don't I keep here and let me just pay, let's say 5 or 10 cents for the 27 strike call. Let me go further out of the money. Let me buy a cheaper call here. I'm only going to get 20 cents of premium. But now what I've done is I've left my upside open. Now, I wouldn't do this on a new married put that I just opened. Well, the implied volatility might be a little bit better where I could get a better kick of an income method number 6 than we're seeing here. What is that income method number 6? I sold a 24 strike that's slightly out of the money for 30 cents, and I bought a 27 strike for 10 cents. So I get a net credit of 20 cents, but I've entered an obligation to deliver shares of stock at 24 and have the right to buy them at 27. We just did a bear call credit spread. But we did it in the context of owning the stock position, meaning we don't have any margin requirement. This just looks like a covered call with an extra long call that you paid for by selling this other covered call position against your stock. So the upside is left open for an unexpected movement. You can still take advantage of most of that upside move. You still got some premium to hedge the risk down from 7.7% down to 7, or from $2 down to 180. Not a lot, I know. So I'm saying it's not the best example of income method number 6, but the structure is what solves the problem. Okay? Now, that's the married put. An example of income method number 1, without the specifics of when and how you would use it in the blueprint, and an example of income method number 6 that solves that capped upside problem of income method number 1. Yes, you get less premium. Yes, you reduce your risk by less, but at the same time, you leave the upside open. Now, we've got a specific position here for Edward. All that being said, the introduction to the strategy, for those of you who might not be familiar with it, the reason why there's 12 different income methods, because they work in different market conditions, and at the same time, they solve different problems, right? You have different tools in your toolbox, as discussed in the blueprint. But we're talking about Citi here. Edward purchased Citi. I'm sorry, we're just going to use 200 shares at this point, Edward. Instead of, you put in 1,200. I'm just going to use 200 shares as an example. And your purchase price was $64.03. And we have the long-term November 65 strike put. Oh, this isn't too bad at all. At 465, I believe you said. And of course, we're going to be 1-to-1, so we're going to buy 2. Let's go 465. Now, Citi's down to 62.31. So you're not down too much at all. You're below your put strike price, of course. But looking at this right now, the stock at 62.31, your best premium is probably, okay, it's 63, 62 and a half if it's available, following the at the money bell curve, Edward, that we just discussed. And, you know, your cost basis, though, is up here. We're at 68.68. Well, that's easy, isn't it? I just noticed that. 68.68. That's a great number there. Yager times 2. Okay. Now, you're looking for a hedge. You're looking for, well, hey, the stock is not doing what I want. It's down about $2 from where I purchased it. I wanted to get some premium here, but it's not up as I want. I want it to be up at 65, or I could sell the 65 call. We know Citi has weekly options. Maybe that's what you're looking at to try to get some premium. Let's go 14 days out in time. Again, no 62.50. That's perfectly fine. But I don't want to sell the 62 because it's in the money. Let's take the 63 call at about 92.93 cents. Let's sell 2 of those. Okay. Oh, I'm sorry. I forgot to do something real quick. We're going to go back to that. I apologize, folks. You only have a 5.4% risk. That's what I wanted to see first, Edward. So there we are, $736 on 200 shares. Naturally, of course, half of that, it was 68.68, and we have the 65 put, so 368, still 5.4% for 100 shares. Now, 14 days again, sell that 63 call for 93 cents. But remember, your cost basis is 68.68. What do we expect to see here? The risk went up to 7%. Why? To the upside. Because with a cost basis of 68.68, we're agreeing to give up our shares potentially at $63 per share. That's the obligation of selling a call, whether it's an income method number 1, Edward, or whether it is an income method number 6. That obligation still exists. Okay? Max potential return, I know it's 14 days out, Edward. I didn't go a month out, and you know, that's just because we just wanted to look at this real quick. But look, 0.1%. Okay, break even. Better than the loss you might be now if you liquidate the position. Max risk of 7% to the upside. And as you can see here by the chart, if you sold this call, if the stock continues to pull down to say 62 or 61.50 or 61, you know, at the halfway point for the call, okay, but even at expiration on 6/14, at 61, $1.31 away, you're at a loss of 159.60. Selling this call below the put strike price, we move that same $1.31, put us up to 63.60, 63.50, almost to 64. We're still at a loss. How can we change that? What if we buy a call, complete the bear call spread, the income method number 6? Let's go, well, I just made the reference of a double Yager at 68.68, so let's go Mario Lemieux 66 at 16 cents. So we're going to take in 93 cents. We're going to buy the 66 call at 16 cents, same expiration to complete the bear call spread. Now, what do we notice? That upside, we still get a premium, of course. You know, we're taking in 186 or 93 cents. We're paying 16. So we're still taking a premium into this position. But because of that extra price we paid, we don't see the profit at 63. We don't hit a break even till 68.34. You're in no man's land. You're in lost land here on this position. This is using the 14-day out series, Edward, I know. But we're in no man's land here for a while. Did you generate a premium to help hedge the position? Yes. Are you being an active radioactive trader by forcing an income method into this position where the call is below the put strike price? Yes. Is this something that suits your goals for this position, or is acting as a good hedge against the original position you've had? Yeah, you've lowered your maximum risk to 4.3%. But any time period in here, you're going to still be at a loss on the position. I don't know if this matches your goals for the trade. Is the answer to go further out in time? use the same strikes. I'm going to use the 63 below the put strike price and the 66 strike, but I'm going to come across the same problem. I'm selling too far below my put strike price because the stock has fallen, and it's well below my cost basis. Let's go to the quarterly, since Citi offers quarterlies. 28 days out, like a month out, like a standard monthly expiration, Edward. 63 versus 66. Now we're getting in 148, and we're going to pay about 52. Now, okay, so maybe we're going to get almost close to a full dollar here. We're going to sell 63, buy the 66, 3-point spread. Okay, so yeah, just about a dollar, 99 cents or so, or 99.5 cents premium. You lower the risk to 4%, you're still in no man's land. Break even drops to 68.24 in 30 days. That's not at November expiration. That's based on the expiration of the call that you sold here on the profit and loss chart. And it is taking into account the remaining theoretical value of the long put. What is this chart telling me? When I keep saying no man's land, what do I mean? What am I evaluating? What has happened, Edward, has happened. Stock's not meeting your expectations. Instead of moving up the 3 to 4 or 3 to 6% in the first 20 to 40 days, it's actually dropped about 2 points. The stock's wavering. We're not seeing any strong movement on the security that we were looking for. We wouldn't expect any strong movement, Edward, honestly, on Citigroup anyway, simply because it's more of a lower volatility. It is a growth stock, absolutely, but it's slower growth compared to some other positions we might have seen on the search results in the married put search, the default married put search that follows what's in the blueprint. I keep going back to this concept of this idea of 3 to 6% in the first 20 to 40 days and another maybe 5 to 8% in the 60 to 90 days following that. Positive gain on the position. Are we always right? No, but that's what we're looking for when we open a married put. When you originally opened this married put, this would have been your expectations. As you know, Edward, in the blueprint for each of the 12 different income methods, in addition to discussion of what it is, how to structure it, whether the stock has moved up, income methods number 1 through 6 are usually best used if the stock moves up. If the stock is stagnating, might use 6, might use 3, might use 7, okay? The stock falls in price, I might use 12, I might use 9, I might use a combination of 9 and 1 or 9 and 3. Now, in addition to the hows and whys and structures of it, each income method has its own chapter in the blueprint, but it discusses what's called the CEGA model. What are the current conditions? That's right, Con. What are the expectations now that the conditions have happened? What are the goals for the trade? And you want it to be a little bit more advanced than not to lose money, but you have a target goal of why you're using this strategy in your portfolio, not only to control risk, not only to avoid the losses that got you out of covered calls or cash secured naked puts or other more leveraged strategies because you were never getting ahead. And that determines your action. Okay, so that's our goal. Before I do any income method, Edward, on a married put position, rather than saying, oh, I know there's this neat little 5 trick I can do that could help me get back to break even faster, this ratio call spread. I know there's this neat income method number 6. It's a bear call spread, but because I own the stock, I leave the upside open because of that extra call. Even if the stock does go up here and I'm assigned on this short call for my stock, as it continues to go, that long call that I got paid to own is just gaining value. Oh, and there's neutral ones too. I can throw in a little radioactive condor or something along those lines. Income method number 8, income method number 11, a little butterfly. But only if it matches this. What are the current conditions? We entered into a married put position, radioactive profit machine, an RPM on Citi. We paid $64 odd for it, and we have the November 65 put. The stock has dropped $2 against us, so the stock is down and currently not meeting our initial expectations. But now that it's happened, what are the current conditions of C itself and the market in general? What are my expectations foresee going forward? What are my goals for the position? Is it to gain consistent income, or is it more of expected longer term growth, knowing that sometimes there's going to be little hiccups in the banking industry, the oil industry, other industries where my stock is? And that's going to determine my action. Does this profit and loss chart of even selling this slightly out of the money 63 call with combinations of the 66 call to do the bear call credit spread, Edward, 14 days out in time, now 30 days out in time, does this view match anything related to your CEGA model for Citi going forward? If not, then we want to go and consider a different adjustment, or we want to maybe leave the position alone for now and wait to see what the market does. If you're bearish in the market going forward, you may want to consider that income method number 12 option to add more protection in the short term, but still bullish longer term. Hey, I think the market's going to start to hesitate. It's going to start to pull back. Things in the news might be affecting that right now. So I'm concerned about a pullback in the market. I can do nothing and wait, or I can add extra protection to the downside. If you think Citi has paused for a moment, it's in hesitate mode, then that's okay. You may still be able to get premium. You go 28 days out with the 65 call, you might see a better profit and loss chart than what we were just looking at with this income method number 6. Again, although that bear call credit spread, that income method number 6, enters us into a position that leaves the upside open in the married put trade over income method number 1, if I don't have a good swath of an upper and lower break even, if I don't have a good potential return for my expectation, hey, I think the stock's going to recover and move back up to 63.50 or 64. If that's my expectation, Edward, I'm honestly waiting to get a better premium here at these prices equal to the put strike price or above, rather than forcing it right now. If, again, we talked about this a couple weeks ago, I could consider maybe trying to get a better break even. Let's go back to 100 shares. It might be easier to show this in that value. We talked about one of the other income methods, income method number 9, and I'm in a conundrum with this in one of my trades as well. One of my open married puts here that we have in the Fusion portfolio at Radioactive Trading. The stock is pulled back from where I initially entered it, and it's been wavering. We're in the November 65 put that you paid $465 for. Okay, it's not a lot, but it's priced at $515, $550. Mathematically, yeah, it's only 50 cents, Edward, I get it, but you've got a 10% gain on the put. That's something you might consider to manipulate. If I sell to close that put now, remember our cost basis, double Yager, 68.68. This would lower my cost basis down to 63.35 if I sold the put right now. Hey, you're still doing better off than when you purchased the stock. But I don't want to leave that downside open in this scenario. Maybe following the at-the-money bell curve, I still want protection, but I just got $5.15, $5.35 back for it. Yeah, let me pay $4 here. So I'm going to generate $135 roughly in premium, $132 in premium. Let's call that an even 4. That's that 4 or 5 or 4. I'm going to call it 4. We wouldn't get 4 for it, I know, but I'm going to call it 4. So now we've lowered our cost basis. I'm sorry, it moved up to 67.35. We have a higher risk of 486, but we have a better break even. I'm sorry, no, we did lower. I'm sorry, folks. We lowered it from 68.68 to 67.35. So you've lowered your cost basis in the position. Now, what do you have? A 62.50 put. What would it look like now if I sold that 63 call? Is it going to look any better? Are we going to have better than that 0.1% return if the stock was trading right at 63? Yeah, it's 0.2. Sorry. Break even, not much better. So, but going a month out, maybe a little bit more. That's the income method number 9. You're taking advantage of this. I don't think we've seen a big enough drop in the stock price yet where I would consider this. Want to get tricky? I mentioned that combination of income method number 9 and income method number 3. I've sold this now, taken a 70-cent gain or so on my put, 50 cents or so, that 10% gain. But let me move into July with that 60. Did I use the 63 or the 60? Okay, I think I used the 63. But let's use the 63 put for July, which is oh no, I can't use that one. Sorry, folks. Bid-ask spread is too wide. I want something a little bit more common. Let's go to standard July expiration. And 62.50, perfect. Okay. So this is only going to cost me about 220, Edward. So what am I doing? I'm rolling down the put, but I'm also moving it closer in time. I'm getting a premium back of about 210. So now my break even is down to 65.56. That's a 9 and 3 combo in itself. Why would I do that? Why would I shorten the time? Well, it's because maybe in the shorter term now, my expectations have changed. I expect Citi to recover, but I'm not as bullish as I was longer term. I think this may recover. It may hit a bottom and may recover and start moving back up. I've lowered my cost basis down about 3 points. And what happens now if I get creative? I know it's a lot. But again, that's the point. It gives you the options. We can do different things like this. Where would we be at? No, not what we wanted, not what I thought. Now, the risk has dropped down to 3.3%, but no, this isn't where I want to go. We'd have to go further out on this call against the cost basis, because the cost base is still 65.56. So I'd still want to be selling a 65.66 call. My apologies, Edward. But that's taking profit off the put. It's only 70 or so cents right now. I know. I don't think it's in the right spot to do that. But restructuring the trade. Think about it this way. If you just owned the stock and it fell and you thought it was going to recover, how could you get back to break even faster? We would buy more shares to average down. Essentially, that's what we just did, except for instead of paying more money into the position, even though it lowered our cost basis or our break even, we got paid a premium. We already accounted for the 465 in the cost basis of our married put. Selling it here at 535 and buying this other put at 220 is going to bring us in $3.10. I think I said 210 by mistake. It's going to bring us in 310 in premium, knocking the break even down to 65.56 for a better recovery and a better chance at break even. Then if the stock starts to move up, now you can evaluate. Maybe that income method number 6 looks better with a stock at 63, maybe selling the 64 and buying the 66. Or it moves back up to 63.50. Maybe that 65.68 or 65.67 combination bear call spread, your income method number 6, looks better. That's the advantage of the blueprint.